Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 5th, 2018. It was only a few minutes before the close. I was going to hold off until after the close today to do this video, but figured we're not going to see a lot. I think we'll probably park the indexes about where they are today. Maybe get a little sell into the close. There's less than 5 minutes to go as I start this video. So just wanted to share my thoughts and also somewhat of a gradual shift in my bias. I've been bullish since the lows here, calling for, most likely some marginal new highs in the market. At least that would be my preferred scenario to see before a meaningful reversal. So far, you can see that we're starting out with the QQQ 60-minute chart. We virtually matched the previous highs. I think we've a few pennies shy, but that's technically insignificant. As you can see here, it's pretty much a double top pattern from the late January highs right here. That was a divergent high there. We had a divergent high there. That's what the DH means, divergent highs with negative divergence on between price and the indicators, and each of those followed by corrections that ranged in size from very minor to pretty darn big. So where we're at today is, let's clear those lines out. Couple things that stand out. We had this was really a culmination of several divergent highs, culminating in this one divergent high here. And at the time, I was focusing mostly on the futures charts. And we had some very clean up trend lines, and those broke. This correction terminated with a divergent low, first divergent low we've seen in a while. The divergence was even stronger, considerably stronger in the NASDAQ futures. It looks about flat line there and a little bit slightly upward sloping here versus prices making that lower low. So that launched the big run that we had, at least in QQQ, to match those previous highs. Now, what do I see? I mentioned recently this most recent run off the lows in February. I think it was February 9th, was it? Yeah, February 9th lows terminated with another divergent high, and that's so far played out for correction. And this appears to be the first leg down right here in the correction. We had a kickback rally, and here's what I'm looking at now. A couple things. We do have this resistance zone that I've highlighted before. Right here, it runs from about 168.22 to down to 167.73. Excuse me. There's a gap above it. So again, it's a zone, an area where the Qs could reverse. But one of the things concerning me at this point in time about how much more upside this rally has, and I'm watching closely, are the trend indicators. One of my favorite trend indicators for the near to intermediate term trend is the PPO signal line. I talk about it a lot, the 9EMA. What I'm looking at here is the 9EMA, the white line is still below the zero line, has yet to cross, and it appears to be rolling over. We haven't yet rolled over yet. They're still pointing higher. So let me just say this, there's certainly the possibility we can power on through, take out the highs, and have that trend indicator flip. However, caution is in order because it's still bearish, meaning still below the zero line and has been since this cross right here. Last time it crossed before that was there. We had a cross here and a cross here. You might not be able to make that out on the video, but I'll zoom in and you can see how well those worked as timing indicators. Now these weren't very big drops because we hadn't had a big drop in a really big drop in over a year, and the rally in January was very strong. Now it kept you long throughout the January rally. Here it flipped back bullish right there, and told you the trend was bullish up until this point. Remember, trend indicators, I don't use them as standalone buy and sell signals, but they do help confirm sell signals such as trend line breaks that we had here on the indexes, or breakouts, other things such as divergence on the bottom. So it helps you get long and tell you where the trend is. And if we zoom in a little bit, okay, you can see the line right there. The white line still well below zero. Now let's go back in time because those other ones may not stand out very much on the video. But when you really take a closer look, there's a closing bell, you can see the trend was bearish from this point, right about when we had that big red candlestick down, and told you at that point the correction was over. So they're pretty pretty accurate. And again, these were small moves, but that's because we haven't had a big drop in the market in a while. So all I'm trying to point out is again, nothing's perfect, but they do pretty well defining the trend. And that is again what's giving me some pause right now is we're still below trend. So if we are rejected here, the zero line often acts as a zero line being this dotted line on the PPO. You can use a MACD as well. It works very similar. That often serves as resistance when back tested below once you get below trend. It didn't do it here because we had a very healthy correction and prices had dropped a lot. The market was very oversold near term and we didn't really need to back test it because we already had a nice flush out. So that's that. That's how it looks on the QQQ. And again, something to monitor, but until we take that level out, let's just say I went from a slightly near-term bullish to almost a neutral to even in the next few days, if you're really trying to hone in, a slightly downward bias because we may get rejected there, come back in. Now this is a 60-minute chart of SPY. You can see the same thing. In fact, this has just done a bang up job, this trend indicator of defining the trend on the SPY. Going back to the left of the chart, which goes all the way back into November of last year, you can see that PPO signal line, the white line, was always above zero, the zero line, until this point. In fact, we had several tests. As I said, that line often acts as support when tested from above and resistance when tested from below. So it's done just a phenomenal job of, if you were in the S&P 500, telling you the trend was bullish without any concern until, first, this is where, it was posted on the right side of the chart, sell signal confirmed on all the US stock markets once these trend lines broke that I was watching on the 60-minute chart. Then just a couple days or a day or two later, maybe even the following day, this is a 60-minute chart, right about this point in time, boom, the trend indicator confirmed bearish trend. Um, and really those two alone, it doesn't get much better than that. Sometimes you get a breakdown of a bearish rising wedge or a trend line, then you get a kickback rally at higher levels. But when you have both in close proximity, sell signal and a trend line break, bearish rising wedge pattern, then the trend indicator's flipping, that's about as high probability as it gets. So we all know what happened then. We bottomed on February 9th, and the case was made that the markets would hold, and they did, especially on the weekly charts. We held that weekly support and everything else. And at this point, we flipped bullish. And so that helped confirm, hey, time to, safe to get back in the water. On the long side, we've hit the second of three targets on the S&P 500 or the SPY, and that recent advance fell just shy of my third target here, and it did so, as pointed out recently, with negative divergence in place on the 60-minute time frame. So as I mentioned last week in the video, last update on the market, as well as going over the top components of the S&P 500 and NASDAQ 100, my concern is that these 60-minute divergences can play out for a pretty healthy correction. So let's see what happens. We're at resistance. I had a resistance zone here we hit. I have another pretty well-defined resistance level here. That was our former second target. That's where we reversed the first time we hit it. Then we gapped above it, so there's a gap there as well, and we fell back below it. So there's the story on the S&P 500, and it's going back to the trend indicator. At this point here, it flipped back. Again, the 60-minute trend indicator flipped back to bearish, remains bearish, and if we roll over here, if we're rejected, again, don't look at the PPO, don't put too much focus on that PPO line. I use the signal line because it's always the ladder of the two to cross. And therefore, by using that white line, the signal line, it filters out the whipsaw signals. You have fewer false buy and sell signals on this trend indicator. So that would be bearish. And if so, you would expect maybe another test of these recent lows. We overshot my support zone a little bit last time around, it briefly, and shot back above it. So that support zone now loses a little bit of validity because it's been sliced through quite a bit, traded through. So I'm not putting as much stock or a higher weighting on that anymore. We'll have to watch this previous reaction low. And of course, divergences are just one of many things. So are trend indicators. let's look for a break and a move up here or beyond. That would be bullish, obviously. It would be bullish because it would take this trend indicator and it would cross that signal line back above the zero line, flipping the trend back to bullish. It would have told us at that time, especially if we can take out these previous highs, that those divergences have already played out. But one final thing to watch for, if I extend that divergence line, I talk about this often. Sometimes you have these initial divergences, you get that first correction, then you push up, and these divergences can be extended as long as we don't take out these prior peaks, especially this first peak back here. So that's what I'm looking at. Divergences, both bullish and bearish, are a big part of my trading. I look at that. So let's just draw a straight line right here, about even with that peak. If and when we go above there, then these 60-minute divergences are burned through now. What it means is this divergence had played out, and we're probably going to go on to do that, either match or take out those new highs. So that's your bullish scenario right there. Those are things I'm looking for. Number one, cross above the zero line. Number two, if we can take out that trend line as drawn, that would be bullish. Otherwise, we could reverse there if we have a little bit higher pop just above this level here. Let me draw it out for you. Okay, let's just say we go up a little bit, hit that third target, and then reverse. You can see it would be drawn like this. You'd have that first divergence. This would be an extension of those existing divergences. We'd come up like this and then reverse. So this is what I'm watching for. And yeah, is it a bunch of scenarios? It is. But I'm also telling you right now, my convictions aren't very strong. I've made that very clear. You know, booking profits on my index shorts personally back here, even though we had the official target here on the trade. It's been a chop fest and it may continue to be a chop fest. The charts just aren't that clear. It's still anybody's game right now. But these are things to look for if you're either long or looking to get add some long exposure, or if you're short and you're looking where to add short exposure when the bearish case is confirmed. Those are the things. Are we going to be rejected if we're here soon or a little higher off the zero line with the PPO 9 EMA? Um, are we going to take out these recent lows right here? That's not going to look good if we do. At this point in time, I don't want to see us get back anywhere close to those recent lows, from February 9th until we get up near closer to these highs. Otherwise, it just shows that the bounce was pretty weak and sold into. And again, I made the case on last week's video. There's a lot of key market leading stocks that are back testing pretty significant resistance levels, trend lines from below, things like that. There's still some above trend, quite a few, and that's why I'm not getting overly bearish either right now. I'm just, you know, have maintained on at least on the site with the trade ideas and my own trading, a net long bias from this point here, around this time, after moving from a net short bias up here when we had these sell signals and all that. And I'm also focusing more my effort. As you guys know, I did an extensive video on the site for members on commodities, covering all the commodity ETNs. I've been doing a lot of we've had official trade ideas, unofficial trade ideas, and some analysis on U.S. Treasuries. So I'm sort of spreading my eggs around different baskets right now, different asset classes. It's not all about the stock market. There are times I have a strong conviction and my exposure, whether it's net long or net short, is pretty heavy. And there's times that I don't have a very strong conviction. So I either stand aside or I'll look at individual stocks that have the best, trading opportunities and other asset classes, gold, oil, various commodities, um, bonds, and things like that. And of course, bigger picture, and bigger picture speaks to long-term funds, 401k money, your IRAs, long-term accounts, where if you've been long or have gotten long recently and want to stay long until the trend is proven otherwise. Right now, we're still in an uptrend, and as I've been harping on, both the Nasdaq 100 as well as the S&P 500 are these primary uptrend lines. In the case of the SPY, the tracking ETF, that's the early 16 lows. We've had these are weekly candlesticks, and we've had several tests of that trend line, a couple back here, Uh, Nice test. We bounced off it there. We tested it there. We had this is what we call a stick save where we had that big intra-week break, but again, it didn't matter because we closed the week right about on that trend line. Tested it the following week, tested it last week, and successfully held. And so far, we're trading above there. And this, in my opinion, is why. Unless you want to try to get in front of a trade, sometimes I'll do that. At this point, I don't feel like it, and I'm referring to being short right now. This is why um, I'm not short the broad markets at this point in time. I'm just rather sit back, let the bulls and the bears duke it out, for the next few days, see what happens this week, and we'll go from there. But until then, near term, like I said, we're at some pretty key levels, so I want to watch and see what happens. And I would still very much like to see my preferred scenario of a marginal new high in the S&P 500, which would be a divergent high, going on to then break that long-term trend line. I think that would set us up for a very high probability swing short entry on the markets. But again, it's just a scenario, and right now we've got to get out of this mess before we can even say, yeah, okay, that scenario looks like it's very much in play. Came very close on the QQQ or the NDX, but not yet on the SPY. Okay, I think I'll wrap it up here. I was going to talk a little bit about Treasury bonds because my outlook is near-term outlook is starting to change on those, and it does mesh with my outlook for the markets. But we have a couple of bond ETFs as official trade ideas, and generally, as a rule, I cover the official trade ideas in whether it's in video or static post update. That's for members of the site. So if you are following a site, taking advantage of the free content like these videos on the general market analysis, you might want to check out our new daily digest. Those are email updates. You can visit rightsideofthechart.com. Scroll down towards the bottom of the homepage. There's a sign up form. Our new daily digest will now send out all public content, and that includes videos that are posted on the YouTube channel or on the site, any chart images, other things like that that are available for the public content without having to log in or register. And you get the entire post sent to you in your inbox at the end of each day. They're sent out shortly after 5 p.m. Eastern time. So that contrasts with the previous daily digest. If you followed the site for a while, the one complaint that I had is it would send out a summary of each post or a quick excerpt, and you had to click a link. And the problem was it sent out both the premium content or protected post as well as the free content. So if you were not a member of the site and you clicked on a link, you were directed back to the site, and then you were told you had to log in. So that's the benefit of the new daily digest. It is only all the public content sent to your inbox. And again, check that out. And I welcome any feedback on that for those of you who are using the new daily digest. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it. And as always, if you liked the video, please give a thumbs up on YouTube.